Well, lately there have been concerns that Warren Buffett may be losing his touch. He's failed to beat the market in 4 of the past 5 years, and today he further disappointed investors as his company missed estimates. Berkshire Hathaway's first quarter net earnings fell 6.6% to $4.7 billion from the same period a year ago. A drop for Berkshire's insurance operations was the biggest negative. Wall Street closely monitors Berkshire earnings reports because the conglomerate invests in companies that touch many consumers' lives, including Coke, ExxonMobil, and Walmart. Berkshire A shares also closed down less than 1% at $192,255. Well, for more on Buffett and Berkshire, we're joined by Charles Ortel, Managing Director of Newport Value Partners. Charles, good to have you back on the show.
Thanks for having me on.
Disappointing earnings out of Berkshire. What's your take?
It's really not surprising. I think when you get to be as big as Berkshire Hathaway is and as Warren Buffett is, it's very tough to outperform the market. And my disappointment with this whole company and his style is that if you look at the period from 1965 to 1998-99, that's when he really outperformed. But ever since then,
I don't know if that's fair. I mean, Hathaway, if he bought a Berkshire Hathaway at over $11 when Warren Buffett took control of the firm 50 years ago, and you would have kept it, you would have seen its value hit an all-time peak of around $190,000. That's a 21% annual return. So there's something to be said about consistency. Yes, the markets have been on a tear lately due to a number of factors, the Fed being a big part of them, but he has had consistent, solid returns.
Well, let's talk about that a little bit. I think that there's no question the book value per share statistics that you cite are correct. I mean, the share price statistics are correct. But unlike Mr. Buffett, who loves to receive dividends, Berkshire Hathaway doesn't pay a common stock dividend. So, yes, patient shareholders who got in early have done fantastically well. But that's not the way the big boys are judged. The big boys are judged, and big girls are judged on how they do versus the theoretical ideal,
right,
which could have been a lot better. I mean, here's a man who in 1998-99 had a gigantic company flush with cash. Think of what he could have done, and he avoided technology.
But that was to his credit, that he avoided technology in the late 90s, and he also avoided suffering major losses in the dot-com burst. He spared the company that agony and still made a profit. So one could say he called it correctly.
Well, except that in 1998, I believe that's the year that Google was founded. And,
hey,
and he didn't
even missed some, for sure.
Well, but
overall, he avoided the massacre of the dot-com burst.
Right, but look at Google's market value. Look at Google's metrics. I mean, he's very fond of talking about. I did this actually yesterday, looking closely at Google.
But Charles, that's one share. He's a trend spotter. He's a trend investor. And yes, Buffett has shied away from technology stocks. It could be argued that that could be to his detriment. Do you think that it's time then with the social media shares that he gets on board that train?
No, I think he really should have a fresh team come and look at this business, particularly because he has not yet publicly identified a successor. He should have some fresh minds come and say, listen, we've got a gigantic pile of wealth. We've had a long ride. He's not going to be around for the next 50 years.
And that's a valid point, the succession plan. There's talk that his son Howard would be tapped. At the moment, the portfolio is also run by we've got Ted Weschler and Todd Combs. So all the power is not with Buffett at the moment. Do you still think he's making the majority of investment decisions?
I think he and his longtime partner, Charlie Munger, very much are all over the important big investment decisions. But therein again lies another problem. If you have a market value approaching $300 billion, depending on how you look at it, a single investment, a large investment of $25 billion, even if it goes up to triple, doesn't really have that much of an impact.
It's such a huge conglomerate, and there have been calls recently to perhaps look at splitting it up. What do you think?
Well, I would certainly consider a different brand of disclosure. When you have something that's this big, nothing is material to the consolidated Berkshire Hathaway, and I'd like to see a much deeper dive into each of the important constituent elements than he provides. He doesn't provide, for example, free cash flow by important business unit. If these big companies like Burlington Northern and Heinz, et cetera, were independent, you'd have a tremendous amount more information, the kind of stuff I like to look at. And at minimum, he should do that. So that we get a better sense of what's really driving the value creation in this business.
Given all that, would you buy a Berkshire Hathaway share at the moment, A or B class?
Neither at this time. No, I don't think that a retail investor has to buy a conglomerate unless the conglomerate has a demonstrated track record for either buying really, really well in the current market, which he has not done, I don't think, or adding value, paying a big price and adding value by management or other expertise. And he's not doing that either.
All right. Well, a lot of people still gathering to hear him speak in Omaha, Nebraska this weekend and into next week. Thank you so much for your insight, Charles Ortel, Managing Director of Newport Value Partners.